Today, the market is telling two different stories at the same time. One story says inflation is back, oil is hot, rates may stay higher for longer, and expensive growth stocks should be under pressure. But the other story says something very different. Nvidia is still strong. AI stocks are still attracting money. Investors are still willing to pay for companies they believe can dominate the next decade. So the real question is not just why Nvidia is rising. The real question is this: why are investors still buying AI when the macro picture is getting harder? For a while, the market wanted to believe the inflation problem was mostly behind us. Inflation cools, the economy slows without breaking, the Fed cuts rates, and stocks go higher. But markets rarely give you the clean version for very long. Inflation pressure came back into focus. Energy prices added concern, producer prices were hotter than expected, and investors had to rethink the rate path. That matters for AI stocks because high-growth companies are not only priced on what they earn today, they are priced on what investors believe they can earn years from now. When interest rates stay high, those future profits become less valuable in today's money. In theory, sticky inflation should be bad for expensive technology stocks. But the market is not a textbook. Sometimes the market asks a different question. If I do not own AI, what else do I own? This is why Nvidia is so important. Nvidia is not being treated like a normal chip stock anymore. It is being treated like a scarce asset. To many investors, AI is no longer just a theme. It is becoming a profit cycle. Large language models need compute. Cloud companies need GPUs, and data centers need more capacity. That does not mean Nvidia has no risk. It does not mean the stock is cheap. It does not mean the story can never disappoint. But it explains why money keeps crowding into the name. In a high-rate market, investors do not want vague growth. They want visible growth, pricing power, and demand that can survive a tougher economy. There is also the China angle. Reports that some Chinese companies could buy Nvidia's H200 chips changed the mood around the stock, not because every risk disappeared, but because expectations changed. Stocks do not only react to good or bad news, they react to news compared with expectations. Bad news that is less bad than feared can push a stock higher. In Nvidia's case, any sign that demand from China might remain partly open gives investors another reason to stay with the AI trade. It does not remove long-term geopolitical risk, but it can change short-term risk appetite. Now, add the Federal Reserve. When the Fed changes leadership, the market is not only asking who is in charge, it is asking how the new Fed will react. If inflation stays high, will the Fed become more hawkish? If the labor market weakens, will it cut faster? If AI stocks keep rising, will the Fed worry that financial conditions are too loose? The market can handle a hawkish Fed. It can handle a dovish Fed. What it struggles with is uncertainty. And today, the setup is full of uncertainty. Inflation is not fully solved. Oil is adding pressure. AI leaders are already expensive, and investors are still acting like the strongest companies deserve premium prices. This is the most important part. The market can look strong while still being narrow. If a few giant AI-related companies are carrying the index, the headline says, stocks are rising. But under the surface, many investors may not feel a bull market at all. Your portfolio can be flat while the index makes new highs. Your stocks can struggle while Nvidia keeps rising. That does not mean the market is fake. It means the market is selective. Money is not buying everything. It is buying what it believes is most certain. And when certainty is scarce, the few companies that look certain become very expensive. That is where the danger begins, because good companies still have to keep beating higher expectations. The risk is not that AI suddenly stops mattering tomorrow. The risk is that the price already assumes too much perfection. AI can be real. Nvidia can be an incredible company. Demand can remain strong. And the stock can still become vulnerable if expectations rise faster than reality. So what should investors watch now? First, watch market breadth. If only Nvidia is rising, the trade is getting more fragile. If the AI theme spreads, the rally is healthier. Second, watch bond yields. If inflation and oil keep pushing yields higher, expensive tech stocks will have a harder time. Third, watch earnings quality, not just revenue and not just headlines. Watch margins, guidance, orders, and capital spending from the big cloud companies. So here is the market today. Inflation is back in the conversation. The Fed is entering a new chapter. China news has improved sentiment around Nvidia, and AI remains the strongest profit story in the market. If you already own the winners, the biggest risk is turning profits into belief. If you miss the move, the biggest risk is letting regret force you to chase. Inflation is reminding you about risk. Nvidia is reminding you about trend. Your job is to remember both.